Welcome back to the LeverUp podcast. I'm Marcus, and today we're covering one of the most requested topics we get from newer traders: leverage. What it actually is, how the math works, and more importantly, what it does to your risk picture. With me today is James from the LeverUp team. James, thanks for being here.
Happy to be here. This is a topic I think deserves more honest explanation than it usually gets.
That's a good way to frame it. Let's start from absolute zero. What is leverage trading and why does it exist?
The core idea is simple. Leverage lets you control a position larger than the capital you've actually deposited. You put up $100, choose a leverage multiplier, say 10 times, and now you're controlling a $1,000 position. Your gains and losses are both calculated on that full $1,000, not on the 100 you put up.
So you're effectively borrowing the difference.
In a sense, yes. The protocol extends your buying power. The mechanics differ slightly across venues. Some use actual lending, perpetual futures use a margin system, but the economic effect is the same. You're exposed to a larger notional position than your deposited capital.
And the reason this exists, it's not just to let people gamble bigger.
There are legitimate use cases. Efficient capital deployment is a real thing. A hedger who wants to offset a large spot position doesn't want to lock up equivalent capital doing it. Institutions use leverage for that. Traders use it to express high-conviction ideas without tying up their full portfolio. The problem is the tool gets picked up by people who don't fully understand the mechanics, and that's where things go wrong.
Let's walk through the basic math, because I think a lot of people hear 10 times leverage and don't really internalize what that means in dollar terms.
Right, so the formula is straightforward. Position size equals collateral multiplied by leverage. PNL equals position size multiplied by price change percentage.
Give me a concrete example.
Sure, $100 at 10 times leverage controls a $1,000 position. If the asset rises 5%, your gain is $1,000 times 5%. That's $50. 50% return on your $100 collateral. If the asset falls 5%, you lose $50, 50% of your collateral gone on a 5% move.
So the asset moved 5%, but your collateral moved 50%.
Exactly, that's what leverage does. It's a straight multiplier in both directions. At 20 times, a 5% move is a 100% gain or loss on your collateral. At 100 times, a 1% adverse move is enough to wipe it out entirely.
People hear 100 times leverage and think that means 100 times the chance of winning. It doesn't, right?
Not at all. Leverage doesn't change the direction the market moves. A 10 times long profits if price goes up and loses if price goes down, exactly like a 1 times position. The only difference is the magnitude of the outcome. Higher leverage doesn't improve your probability. It amplifies the consequences.
So let's talk about liquidation, because that's the mechanism that makes high leverage genuinely dangerous. What actually happens?
When the market moves against your position far enough, your remaining collateral approaches the maintenance threshold, the minimum the protocol requires to keep the position open. When you hit that threshold, the position is force closed. That's liquidation.
And the key point is that threshold varies with leverage.
Right, the higher your leverage, the closer your liquidation price sits to your entry price. It's a direct relationship. Let me give you the numbers from the article because this table is useful to just know. At 5 times leverage, an adverse move of roughly 17% triggers liquidation. At 10 times, about 8.5%. 20 times gets you to around 4.25%. 50 times, 1.7%. And at 100 times leverage, less than 1% of adverse movement is enough.
Less than 1%. So at 100 times, a coin doesn't even have to have a bad day. it can just have a bad minute.
That's exactly it. Crypto assets move that much routinely. We see hourly candles that large on mid-cap tokens all the time. At 100 times leverage, you're not really managing a trade, you're managing a timer.
So the advice, use 100 times leverage, just don't risk much. Is that actually a valid strategy?
It's not a contradiction. 100 times leverage on 1% of your account has less total dollar exposure than 5 times leverage on your full account. But, and this is important, the liquidation proximity problem doesn't change. Your position can still be wiped out by a sub 1% move. You need to know whether you're okay with that happening and whether you'll be able to act fast enough if the market turns.
Let's talk about the costs that people forget about. You open a leveraged position, and it's not just sitting there for free, right?
No, there are two ongoing costs. The first is the funding rate. In perpetual futures, there's a periodic payment between longs and shorts based on the imbalance in open interest. When more people are long than short, longs pay shorts. When more people are short than long, shorts pay longs. That rate is calculated on your notional position size, not your collateral.
So if I'm at 50 times leverage with $100, I'm paying funding as if I were holding $5,000.
Correct, that's a meaningful difference. At high funding rates, the drag accumulates quickly on multi-day holds.
And the second cost.
Opening and closing fees, also calculated on notional. Same principle. $100 at 50 times has a $5,000 notional, so your fees are on 5,000, not 100. At moderate leverage, that's manageable. At extreme leverage with small collateral, fees can be a significant fraction of your available margin.
There's also an effect on the liquidation price itself, right? These costs don't just hit your P&L, they affect where you get liquidated.
Right, as fees and funding accumulate, they reduce your effective collateral, which means your liquidation price gradually drifts closer to entry while the position is open. On short-term trades, it's minor. On a multi-week hold at high leverage, it can matter. You open thinking your liquidation was at price X, and slowly, without a single market move, it's crept to X minus something. That's a cost people don't account for.
Okay, let's get practical. Someone's considering their first leverage trade. What's the right framework for deciding how much leverage to use?
The common mistake is starting with leverage and working backwards. People ask, what's the max available, and treat that as the default. The better approach is to start with risk and build forward.
Walk me through it.
First step, decide how much of your total account you're willing to lose on this specific trade, not how much you're expecting to make, how much you can absorb if you're wrong. A common professional framework is around 2% of total capital per trade. Second step, identify your stop loss, the price at which the trade is clearly wrong. This is where you'd exit voluntarily. Third step, set leverage so your liquidation price sits beyond your stop loss. You want your own exit decision to trigger before the protocol forces a close. If your stop loss is at -5% and your liquidation is at -4%, you have the order backwards. Your position gets liquidated before you even had a chance to cut it yourself.
That last point is really important. The liquidation shouldn't be the first line of defense. The stop loss should be.
Exactly, liquidation is the protocol protecting itself and you from negative balance. Your stop loss is your decision to exit before it comes to that. Always check where you get liquidated before you open a position. The interface shows it, there's no excuse for not knowing.
What are the most common mistakes you see?
Three main ones. First, maximizing leverage because it's available. The interface offers it, that doesn't mean it's appropriate. Higher leverage just means liquidation proximity, it's not a trading advantage. Second, not checking the liquidation price before entry. People look at the potential gain, confirm the trade, and only find out where they'd be liquidated when the market moves against them. Third, forgetting that fees are on notional. Someone thinks they're making a small trade because their collateral is small, but the fees are on the full notional, and that can be a large number at high leverage.
Let's cover a few quick questions we hear from people just starting out. First one, can you lose more than you deposit?
On most modern perp venues, including LeverUp, no, the position closes before losses exceed your collateral. That's the purpose of liquidation. However, in extremely fast-moving markets with insufficient liquidity, liquidation can occasionally slip, resulting in what the protocol calls bad debt. The protocol absorbs that rather than passing it to the trader, but it's worth understanding before trading large positions. Check how any venue handles that scenario before you trade size.
What leverage should someone brand new to this actually use?
3 to 5 times. That gives you meaningful amplification. Your collateral moves several times the market move, while keeping the liquidation price far enough away to learn without getting wiped out by normal market noise. Understand how holding costs, liquidation prices, and funding interact at that level before touching higher multipliers.
And the difference between margin and leverage. People use those words interchangeably, but they're not the same thing.
Margin is the collateral you post to open the position, the capital you're actually putting up and risking. Leverage is the multiplier applied to that collateral to determine position size. $500 margin at 20 times leverage controls a $10,000 position. Margin is what you risk. Leverage is the amplification factor. Related concepts, different things.
Before we wrap, let me ask the honest question. Is leverage something that helps most retail traders, or is it mostly a way to lose money faster?
Honest answer, in the hands of someone who hasn't done the work to understand it, it accelerates losses. Not because the math is unfair, but because the margin for error collapses as leverage increases. A trade that would have been survivable at 2 times becomes a liquidation at 50 times, but the mechanism itself is neutral. The same math that wipes out an undisciplined trader is used by professionals to manage hedges, express views efficiently, and build systematic strategies. The tool is fine. The problem is people picking it up without understanding what it does.
And the article we're drawing from today, where should people go to read the full version?
It's on the LeverUp blog at blog, LeverUp, Size. The article covers the complete math, the liquidation table, the full framework for position sizing, and links to the liquidation mechanics article for the next level of detail. That's the one to read if you want to understand exactly what happens when a position gets closed, not just that it happens.
What about the ongoing costs, funding rates?
There's a dedicated article on that too. What is a funding rate in crypto? Also on the blog. If you're going to hold leveraged positions beyond a few hours, that's required reading.
All right, let me close with the key takeaways. Position size equals collateral times leverage. PNL is calculated on the full position size, not just your collateral. At 10 times leverage, a 5% market move is a 50% move on your collateral. Leverage does not improve your odds. It amplifies magnitude in both directions and tightens your liquidation proximity. At 100 times, less than 1% of adverse movement triggers a forced close. Fees and funding are on notional, not collateral. They accumulate over time and gradually tighten your liquidation price. The right framework: decide your maximum loss first, set your stop loss where the trade is wrong, then size leverage so liquidation sits beyond that stop. Always check the liquidation price before you confirm. And if you're new, start at 3 to 5 times. Learn the mechanics. Then decide if you want to increase. The full article is at blog, LeverUp, Size. That's all for today. See you next time.